Hello and welcome to your regular update on the UK property market for both UK-based and international-based investors. My name's Arden Hanley and I'm going to take you through a roundup of what's going on with the property market overall. Certainly is eventful times right now, a lot for us to discuss in this update. Let's take a look at what's happening with house prices. Now at this stage, the information we have is to do with house prices up to the end of February 2020. The data at the moment doesn't take into account the effect of the coronavirus or COVID-19 on transaction volumes on house prices overall, and it's expected that there probably will be a drop, at least in terms of transaction volumes and activity for March, due to the measures brought in by the UK government around self-isolation, limiting social contact with people. That is obviously going to have an effect on the amount of business being done in the property market. But for the moment, we can look at what the figures said up until the end of February 2020. And we've continued the trend that we saw in December and January of an increase in house prices overall across the UK generally. Now, the rate of change slowed down slightly according to the Halifax housing report versus a bounce that was seen in December and January, immediately after the Conservatives' big election win. But we still see growth in positive territory, with the Halifax housing report showing 2.8% growth year on year for the same month last year, and the nationwide housing report reporting that figure at 2.3% growth. So both in very positive territory. Now, the prediction at this stage is that growth will probably sit somewhere between about 3 and 5% consistently year on year for the next 5 years or so. However, that growth forecast from a lot of economic experts did come out prior to the start of the coronavirus and COVID-19 crisis in the UK. So it remains to be seen whether any of those forecasts are updated in the wake of the measures that the government has introduced in the UK and what effect that might have in terms of slowing down the housing market. Now, the one thing to remember is this doesn't necessarily do anything to supply and demand overall. What it might do is it might have an impact on transaction volumes. We may be in a situation where there are people in financial distress, and that could have a knock-on effect to mortgage payments and potentially repossessions later on in the year. Although at this stage, the government has been very much putting pressure on the banks, putting pressure on landlords, putting pressure on lots of areas of society to say that actually this is not the time for things like repossessions, landlords to take possession of properties, banks to repossess properties for non-payment. This is a time for everyone to pull together, give each other some leeway, and the government has announced a number of measures to support that as well. So I don't think there will be any immediate effect at this stage on house prices in terms of big drops. Also, I don't think there'll be any significant increases, because we fully expect that transaction volumes will probably slow down in the coming months while the UK deals with the brunt of the coronavirus pandemic as it stands at the moment. Now, just to give you some ideas of where we were at the end of February, we were in a situation where transaction volume above that 100,000 long-term average, so in good territory, over 102,000 transactions for the month. Mortgage approvals in really strong territory, over 70,000, which is one of the highest levels in the last 5 to 10 years as well for mortgage approvals, showing that the market was really getting a lot of business done in the last month. Buyer registrations up significantly, over 20%. Seller registrations up by about 16%, so probably still more a seller's market than a buyer market. Sales agreed also up over 10% as well. It's reported from the estate agency groups. So up until the main force of the coronavirus, the government measures hit, we were in a situation where the housing market was actually pushing on fairly well. Business was getting done after being in a kind of situation where a lot of people were sitting on their hands because of the uncertainty over Brexit. So, as I said earlier, it remains to be seen what happens with house prices and transaction volumes over the coming months, with all of the measures that have gone in place to deal with the COVID-19 outbreak in the UK. However, I would reiterate that this doesn't upset the balance of supply and demand. It's not like we've got a whole lot of new houses coming on stream. We've got to remember the industry we're in, people need somewhere to live. So it's not going to change that balance of supply and demand. There's still going to be people looking to rent. There's still going to be people looking to buy at this stage as well. I think we'll probably just see a slowdown in the amount of business done in the marketplace overall. Let's take a look at the figures around rents reported to the end of February 2020. Now, this doesn't take into account what might have happened with rents over the last couple of weeks, and a bit like house prices are probably going through a period of not necessarily a drop, but probably a stagnation in terms of transaction volumes and things like that due to what's going on with the coronavirus in the UK right now. At this stage, I don't think there's any significant downward pressure on rents, but there probably is a situation where, right as things stand at the moment, there probably won't be a whole lot of new tenancies agreed in the immediate term, just because with all the measures around social distancing and social isolation, it's very difficult for the normal business of renting to go on with viewings and check-ins and check-outs and those kind of things there in the current marketplace at the moment. But if we have a look at what happened with rents to the end of February this year, and information that's come from HomeLet, their regular rental market survey, well, we've still got very strong growth in terms of rents year on year. We're 1.6% up. The rate of growth seems to have slowed down a little bit versus the last 6 months of last year, but still very much in positive territory overall. Regionally, we've got a number of regions showing above that figure in terms of growth, notably being Wales, Northern Ireland, the East Midlands and the Northwest, at a little bit slower levels of growth, but still very much in positive territory. The West Midlands, Yorkshire and the Humber and Scotland. Then we're down a little bit in the southwest, the southeast and the northeast, but remembering that towards the end of last year, pretty much every region in the UK was showing above average rental increases. So not surprising that there's a little bit of flattening out at this stage. What's driving the rental market? Well, we still have very much the same drivers. This comes down to supply and demand overall. We've got a situation right now with a number of landlords who've exited the market over the last 2, 3, 4 years to do with changes to mortgage interest rate relief rules that caused a lot of landlords to assess their portfolios, especially those who had significant portfolios in their personal name and may have had large taxable incomes elsewhere as well. We had the tenant fee ban last year and we saw a big spike in the number of landlords exiting the market because of the tenant fee ban and a corresponding upward pressure in terms of rents in most parts of the UK as well. And then we've got some other issues that are kind of causing some older landlords to think about what they're doing in the marketplace. Also some accidental landlords or landlords who had maybe 1 or 2 buy-to-lets as a pension pot, looking at a lot of the legislation around health and safety, around how tenants are taken care of, additional licensing schemes. All of these have resulted in a reduction in the amount of rental stock available in the marketplace, and that's translating through to an increase in rents. Now, there's a lot of things in the news at the moment about the potential impact of coronavirus or COVID-19 on renting. And that may have a short-term impact, especially with some tenants' abilities to pay. Because ultimately, if your tenant who's in the property loses a job, that may impact their ability to pay. And there's been a lot of government measures announced over the last week around trying to be fair to tenants and giving them potentially some leeway in terms of payments and a cut to any evictions for the next 3 months. Equally, there's also been an announcement that there will be some protections for landlords as well, with pressure on the banks to give kind of payment holidays and things like that if the tenant's not paying the rent. But what I don't think this will do in the short or the long term is produce any real downward pressure on rents. And the reason for that is we might be in a situation where there may be some difficulty short term with cash flow and payment, but we've still got the same issues in the UK overall around the availability of rental stock, but the number of tenants chasing that rental stock. And you can only think that this problem will exacerbate over the coming months, because I imagine that a lot of the shutdown we're seeing in business in the UK and the slowdown in business in the UK because of measures the government government has introduced will have a knock-on effect to things like the construction industry and new stock coming online for the rental market as well. So we're still going to have this kind of supply and demand imbalance, probably very much in favour of landlords. So I think rents will continue to rise as it stands at the moment. Just make sure that you are planning within your portfolio potentially for some interruption to payments in the short term, especially if you have tenants who may be in the hospitality industry, anything affected by aviation. These are or the travel and tourism industry. These are the industries which are going to be really hard hit by the measures around social isolation. But rents definitely in positive territory. We will look to see what happens in the coming weeks, whether there is any wobble in the marketplace in terms of rents. But like I say, I don't expect that rents will go down. It may just be a situation that there are some payment issues, and potentially if you do have any properties right now that are empty, it may be more difficult to get a new tenancy agreed just in the current marketplace, because it's very difficult for lettings agents to do their job overall with some of these restrictions in place. In the last week, we've had a budget announcement from a new Chancellor in the Conservative government, and there's quite a few items to pick up on that are of interest to people invested or looking at investing in property. And this, kind of depends a little bit as well on how your business is structured overall. So let's go through some of the key points for property investors. Now, bearing in mind that there was also quite a bit of this was measures introduced specifically to deal with the crisis around coronavirus in the UK and support for business in this difficult time. But there are also some things for the long term that are very important for us to pick up on as property investors. So let's begin with one of the announcements around the threshold for national insurance contributions. And this may affect a number of landlords, especially landlords who may have properties held in their personal name, also some properties held in a limited company. If you're a UK tax resident, this becomes really important to bear in mind, or you're able to claim the tax-free threshold in the UK as well. There's a little bit more room if you use a structure now where you take some of your income from a limited company as salary. And a lot of us who have property portfolios will have a mixture of income coming from property in a personal name, income coming from property in a limited company, maybe some service income that's coming in a personal name or a limited company. So that generally means that we tend to take a mixture of salary and dividends. And if you are taking that mixture of salary and dividends from your business on your accountant's advice, this means that there's probably a little bit more that you'll be taking out in the 2021 tax year as salary, because there's a little bit more you can take out before you hit that threshold where there have to be national insurance contributions. Ultimately, that threshold has gone from 8,632 up to 9,500. So not a huge amount, but a little bit more that you can squeeze out, a little bit more money in your pocket before you've got to pay those employer and employee national insurance contributions. Also very much related to property investors, if you're doing any sales of property in a personal name, you're flipping anything, or you've got anything in your portfolio that you maybe are offloading that was held in the personal name, a slight increase in the capital gains tax threshold from 12,000 up to 12,300 for the 2021 tax year, and that's in line. Generally that threshold moves up a little bit kind of year on year as well, so not particularly unexpected to see that change in the thresholds. Now, one of the things that was not necessarily a surprise, but we were waiting to see whether the government would put this into legislation or not. For a number of years, it's been written into legislation that the corporation tax rate, the tax rate on limited companies, was going to move from 19% down to 17% for the 2021 tax year. What the government has actually done is they've taken that bit of legislation out and they've left the corporate tax rate for the UK at 19%. Now, this was something that a lot of people were expecting because even though this was written into law, it was written into law about 4 years ago. And we know that a couple of chancellors and also Boris Johnson himself had expressed the view that they wanted to keep the corporate tax rate at 19%, potentially so that later they can use that as a bit of a lever maybe to give a tax reduction to businesses if they need to stimulate the economy in the wake of the coronavirus or COVID-19 problems that are facing the UK. It's one of those levers. So there's an argument there for not reducing tax rates right now because they may want to pull that lever at some point down the track. So that stays at 19%. No better off for people who invest via a limited company or have some of their income coming via a limited company, but also no worse off than where we were in the 1920 tax year. The reduction on mortgage interest rate relief for the 2021 tax year is now fully in effect for those people who hold properties in a personal name. Now, this effectively, what it means is that you pay a tax on your revenue rather than a tax on your profit. And it has the effect of sort of removing about 50% of the deduction you could get for your mortgage interest. It's not quite as simple as that, because what the rules around this actually say is that if you're a higher rate taxpayer in the 40 or 45% band, you can only write off the mortgage interest that you deduct on the basic rate tax band, which is 20%. If you happen to have properties in your personal name but you sit within the basic rate tax band, well, you've still got full deductibility of your expenditure. If you are in that higher rate tax band, this is hurting people at the moment. Now, it's worth just reminding you that that reduction to mortgage interest rate relief doesn't apply to limited companies. Limited companies get full deductibility of all of their mortgage interest, and that's why for a significant period of time a lot of professional investors have either been buying inside a limited company or moving their property portfolio into a limited company to deal with this. But just remember, 2021 tax year, this is fully phased in. Over the previous tax years, it kind of came in as a staged phase in. 25% of your mortgage interest was affected, 50%, 75%. We're now at the stage where all of the mortgage interest is affected like this. And if you do hold properties in a personal name, it would be worth having a conversation with your accountant, because potentially there will be a larger tax bill coming at the end of the 2021 tax year. Now, one of the other things announced in the recent budget was a 2% stamp duty surcharge on foreign buyers of UK property. Now, drilling into the detail on this, it says foreign individuals buying UK property, but also that 2% surcharge on UK-based limited companies owned or controlled by overseas investors as well. So this is coming, and this will come in from April 2021. Now, this potentially may give a small advantage to some UK buyers versus foreign investors, although for a long time we've seen a number of overseas currencies appreciating against the pound as well. So, it's kind of swings and roundabouts on that stage. The government's stated aim around this was not necessarily the entry-level end of the market, where a lot of us operate as investors, average homes for average people. This was very squarely aimed at maybe an overheated London property market. We've seen a number of measures from the UK government over the last couple of years, very firmly aimed at that million-plus price bracket, where an extra 2% will equate to quite a bit of stamp duty that you pay. When we're looking at some of the smaller properties that generally we tap into, actually an extra 2% is not a huge amount, and it's assumed that a lot of overseas buyers will probably just factor this into their offers. But as I say, there are quite a few overseas buyers who may still be in a position where their currency is quite strong versus the pound as it stands at this stage as well. So it is a bit of swings and roundabouts, and these things balance out. This doesn't come in until next year, obviously, as well, so there may very well be quite a few overseas buyers bringing forward their purchasing plans in the short term to get in before this extra stamp duty rate applies as well. And that would be very smart business if you are based outside the UK, to try and make sure your transactions fall on the right side of this deadline. And finally, the budget also announced a number of measures support for businesses around coronavirus. That was some loans that will be available from high street lenders, but effectively underwritten by the UK government, grants for certain types of businesses to help them trade through this period of time. Also, a number of things around sick pay for workers, and there's information there for landlords and renters that is important as well. So there's quite a bit in the budget that was focused on that, but that's kind of a wide topic, so we'll leave the budget just there for the moment on those main headline items, and then in some other sections we'll break down some of the specific budget measures around coronavirus. It's been a busy week in the news around coronavirus and COVID-19 measures for the UK. And ultimately, this does have a knock-on effect to what's going on in the property market overall. So let's look at some of the news that's come out of the government, both in terms of some budget announcements that were made, but also some of the more recent news that's come out of the government as well, where they seem to be going in terms of legislation around this in this time of the country battling to kind of get the spread of coronavirus under control. We're in a situation where the government is stringently pushing us into a situation of self-isolation, social distancing, school closures and things like that at the moment, and that will have a knock-on effect to the property market overall. But let's have a look specifically at some of the things that affect us as property investors, what the government said, what it means in reality on the ground. So the first thing, very well publicised, is the government saying that they're going to put a stop to any evictions for the next 3 months. Now, that potentially could cause an issue for landlords in the UK because there could be a situation where tenants decide not to pay because of this and the landlord can't do anything about it. Yes, that's a potential possibility. However, we need to think about this in practical terms. Now, when this information first broke, there was a bit of a perception in the marketplace that potentially this meant that tenants got a payment holiday, a payment break, and effectively rent-free for 3 months while these measures were in place. That's not actually what happens. What happens at this stage is landlords are being encouraged, if a tenant is in financial difficulty, to give them some leeway for the next 3 months. Now, that doesn't mean that the debt goes away. The tenant will still owe that rent to the landlord, but if they, say, work in one of the really badly hit industries like hospitality, like tourism, which is being really badly hit, they've maybe lost a job or had their hours significantly reduced, that may affect their ability to pay overall. And if that is the case there, the responsible thing to do as a landlord is to give them some leeway, some room to pay, agree a sensible payment plan with them. And we would hope that the majority of tenants do take a practical approach to this, as landlords will, and say, okay, if you can't afford to pay the full rent, what rent can you pay for this period? And then you can agree a payment plan down the track for them to recover as the economy gets back to normal and as life gets back to normal in the UK. Now, corresponding to that, we also have a situation where the government has told mortgage lenders that they will need to give landlords potentially payment holidays as well. But this works the same way for landlords. This is not forgiving the payments that would have to be made during this period of time. This is actually putting them on hold. It's a payment holiday. It doesn't do anything to reduce the debt. It just defers the payment of those interest payments. So it will actually increase payments down the track. So the same way that renters are encouraged not to abuse this and kind of view it as a bit of a giveaway and a reason not to pay, because the debt will still follow them down the track. And while there might be a 3-month ban on evictions, potentially as soon as that's lifted, if they are in arrears, a landlord could serve a Section 8 notice or serve notice under the PRT regime in Scotland to start possession proceedings fairly quickly at that stage. The same thing, landlords need to be responsible with any requests they make to the lender as well, because there may be an argument for a payment holiday right now, especially if you've given a payment holiday to your tenants, but you've got to remember at some point you will have to catch those payments back up as well. So what I would say at this stage is, if you do have a buffer, which most of us should have done by putting some money aside into an MOE account for monthly operating expenses, when you're doing your numbers, we encourage you to stress test those numbers so you've got a bit of a buffer there. I would say don't be too quick to make arrangements with a lender. Do it when you need to make arrangements with a lender, because you don't want to store up problems for down the track and a big problem for later on in terms of catching up on any payment holidays that you might have had to put in place at this particular period of time. We wait to see a little bit more what happens for the longer term with this. These measures have been announced for the next 3 months. This is a moving situation with the government at the moment, and these may potentially be extended. And we've got to remember that this is also by negotiation in this marketplace at the moment as well. So the government said this has to happen, but also there is room for a conversation between landlords and tenants had via the lettings agent, if you have a lettings agent in place, but also landlords to their mortgage lenders as well. And there may be some leeway about when things are recovered, what a reasonable payment plan is to put in place. So do view it as an opportunity to have that conversation and work out some practical solutions to make sure that your business continues, your property portfolio continues, but also if you've got a good tenant in the property who may be in a position where through no fault of their own they've been affected by this and you need to give a little bit of leeway, give them some leeway right now so that you've got the opportunity to keep that good tenant in your property and give them room to recover later on for the long term as well. Now, looking at the practical side of what happens with coronavirus and the business for lettings agents and estate agents. Well, at this stage, we're not seeing any large-scale drops in terms of prices of properties or drops in terms of rental price for properties, but there are some challenges for how business operates in the current marketplace. And that means that a lot of lettings agents, a lot of estate agents have moved to what's a very sensible way of doing business in this current environment, and that is potentially closing their shop fronts, so discouraging face-to-face contact between prospective buyers or prospective renters and their staff, and doing things like video tours, virtual tours of properties, pushing everything to telephone and email contact, which is exactly what we're being told to do in the current marketplace. Now, we can imagine this will probably cause a slowdown in terms of tenancies agreed, in terms of check-ins, check-outs on the rental side, probably a slowdown in terms of sales agreed. But what this doesn't affect is the overall situation we have where there's still a shortage of rental stock in the majority of locations, and that's why we've seen rents going up over the last couple of years fairly consistently, and in some areas rents shooting up by over sort of 5 or 6%, especially in the last 6 months of last year. But also it doesn't affect the shortage of places for people to buy, to live in as well. We still have a chronic shortage of housing across the UK as well. So there's not really anything by itself that says that this restriction on maybe being able to do business, yes, it might drop transaction volume and lets agreed, but it shouldn't at this stage look like it will have any downward pressure on prices. But time will tell, because there is an element, especially to house prices, not so much to do with rents, but to house prices of market sentiment and confidence that may come into play the longer this goes on. Now, the other side of things for lettings agents and estate agents is there is some business that they can do. So if they're doing virtual tours to show your properties and things like that, and there is someone who genuinely wants to take a tenancy, well, the majority of that work can be done electronically, but there is room for them to do physical check-ins or check-outs if those need to happen. It's just about people being sensible, making those arrangements, keeping a good distance when those appointments are made, making sure that you're taking reasonable precautions like hand washing, maybe carrying hand sanitizer, gloves and masks in some situations are appropriate. What this is about is not trying to stop the business going on, but trying to look at how we do business to make sure that people are kept as safe as possible. This also provides a challenge for managing agents around repairs and maintenance, because obviously as landlords we need to make sure that things in our properties are kept in a good state of repair. Important things and necessary things like heat, lighting, power, water supplies, these repairs and maintenance work still needs to continue. The best way of dealing with this at this point in time is anything that is non-essential repairs and maintenance. Best practice at the moment is don't schedule that in if it doesn't need to be done at that point in time. And an example of that might be something like we recently had a number of storms in the UK. Maybe you had some damaged fence panels that are down, which ideally you'd repair and replace fairly quickly for the comfort of your tenant. But in this particular scenario that we're in at the moment, well, that doesn't need to be done right now because it doesn't necessarily affect the tenant's use of the property. So that's something that could be deferred for a few weeks until hopefully we're out of the worst of the coronavirus situation. But something like a boiler repair or a gas safety certificate needing to be done, or maybe a water leak, that still needs to be dealt with at this stage. So lettings agents are still going ahead and booking in those essential repairs and maintenance. The advice to a lot of contractors and tradespeople working in properties is have a conversation with the tenant first, make sure and establish that there's no health problems in the house to begin with. Tradespeople shouldn't be going out. If they're unwell, they should be adhering referring to the self-isolation regime as well, if they're showing any symptoms of the coronavirus or COVID-19 as well. But provided both parties are fit and healthy, then those essential repairs should be going ahead, because it's important to make sure that properties don't fall into a state of disrepair, and also that tenants keep that comfortable, that healthy and safe environment to live in. But some practical steps, like making sure that the tradespeople do come with gloves and potentially with masks in those situations, that tenants and tradespeople limit their contact within the property. So, for example, if the gas engineer needs to go in and do a gas safety certificate check on the boiler, maybe the tenant is in another room while that happens. They give them space so they're not in close proximity, and adhering to the hand washing regime, hand sanitizer as I mentioned, and making sure that there's a good social distance there, that people aren't sneezing and coughing over each other. So we're doing everything we can at all stages in the lettings process to make sure that we do our bit to limit the spread of any infection overall. For those people who have HMOs, there's actually some specific guidance around HMOs as well. So for buy-to-let style properties, there's not really anything that we need to worry about as landlords, because we'll have a single family unit in those properties and self-isolation rules. One person is sick, the whole family self-isolates for 14 days. That's fairly easy to deal with. In HMOs, there actually is some specific guidance, because while it's not a family unit, you do have a number of people who are all together, and the possibility for cross-infection, cross-contamination is very high. So the guidance at this stage, which your lettings agent should be sending out to your tenants, or you as a landlord should be sending out to your tenants if you self-manage, is that if one person in the HMO displays symptoms of coronavirus, the whole occupants of that HMO need to self-isolate for the next 14 days. They need to treat it a little bit as if they were a family unit. We need to be responsible around this overall. Now, potentially, if there is a case of coronavirus in one of your HMOs, there may be a requirement for some deep cleaning, some medical grade cleaning to happen later on. What the government has said is that is at the cost of the landlord. That's not a cost to be borne by the tenant, so just bear that in mind. If there does need to be any type of deep clean to disinfect the property after a coronavirus outbreak in one of your HMOs, that's a potential cost for you as a landlord to bear that will need to be done at some point. Optional measures, it depends a little bit on who you've got in your HMOs, whether this is appropriate or not. I would say the guidance on this is, are you housing any particularly high-risk tenancy groups? So people with known health conditions that would make them more susceptible to the coronavirus, or potentially the devastating effects of coronavirus, potentially putting them into a situation where they might wind up in hospital, or are you housing people who are in that older age group which are at higher risk as well? And if that is the case, they're saying potentially, as a property owner, putting soap in the property, putting hand sanitizer in the property to encourage good practice as well. It's not a requirement, it's an advisory at this stage for people who are housing maybe at-risk tenants in HMO style properties. There's also a couple of guides that have been published online by the government for dealing with situations where you do have a number of people who need to be in close proximity together, but it's not a clinical setting like a hospital as well, and some of the things that can be done in terms of stopping the spread of infection. So it may be worth speaking to your lettings agents, or if you're self-managing, arranging for this information. They're printed posters prepared by the government that you can put up in your HMOs to make sure that you're keeping tenants informed as much as possible about how to keep themselves safe during this difficult time. Now, there's a link there on the screen. There's a really good guide from the NLA RLA. They merged recently on some of the guidance for landlords at these times, and you've got links to some of the information from the government that you can provide to tenants as well. So if you are a member, definitely worth downloading or reading through some of the guidance from the NLA RLA there to make sure that you are operating in the best way during this difficult time. Staying on the theme of government measures, coronavirus business interruption measures. Now, the government has announced a number of measures are coming, and a lot of detail on this is due next week, in week commencing the 23rd of March. The measures they've announced is there will be grants for certain types of businesses, 10,000 or up to 50,000. Now, this is focused predominantly on tourism, on hospitality industry, and a lot of those industries which will have to effectively close down for the good of us all. There's also some grants available for those businesses who are already getting business rate relief as well. We're waiting for the detail next week on exactly how you qualify to get this and how you claim those grants, how they will be paid as well. But it's worth bearing in mind that those things are coming. There's also business interruption loans as well. Now, these are not grants. This is not free money that's coming from the government. This is actually money that's going to be made available by the mainstream lenders, but underwritten by the government. The government underwriting up to 80% of that loan overall. They've also announced the plan is for the government to meet the first 6 months worth of interest payments on these loans. But it's worth bearing in mind these are long-term loans, so there will be a cost to the business. This is about giving businesses the room to borrow with some guarantees from the government to be able to cash flow themselves through this period of time. But it is borrowing, there is a cost attached to it, so you do need to consider whether it's appropriate for your business as well. And it's worth, all of us who are property investors, we may have property related service businesses as well, we want to be looking at the information that's published regards this that's coming out next week, but do consider whether it's appropriate to your business overall, because it is taking on more debt. Now, we can imagine they will loosen up some criteria and make it easier and quicker to qualify for some of these loans, because what the government doesn't want in this situation is a lot of failed businesses over this period and really compounding an already difficult situation because of coronavirus with also a big economic problem. But do think about using this responsibly. The same way when we're looking at a property deal, we do things like stress testing. We look at making sure that we're taking a sensible loan to value, that we've built in that margin to be able to afford to pay for it. A business interruption loan may very well be something that your business needs right now in order to continue to trade, but make sure that it is affordable for the long term. And once we see some detail on how these are going to be put forward, how they're going to be implemented, we will update on that in the coming weeks as well. Anyone who's been looking at what's going on with financial markets in the UK will know that we've had 2 big interest rate cuts in a very short space of time. First off, we had the Bank of England cut the base rate from 0.75% down to 0.25%, and then within a week they've cut down to 0.1%. This is also tied up with the Bank of England announcing they will pump more liquidity into the system. They're bringing more money into the system to make sure that there is liquidity in the UK financial markets, and this is about trying to shore up business confidence in this difficult time and giving businesses enough room to trade through the worst of the coronavirus epidemic in the UK. So ultimately, this also is tied up with what's going on with the wider government announcements around support for businesses during this difficult time. So that's grants to some particular types of businesses severely hit by the impact of COVID-19, but also some business interruption loans, which will be available from mainstream lenders, but will be underwritten and supported by the government. So this is part of a whole range of measures with the government and the Bank of England working together to do everything they can to shore up the financial situation and the economic situation in the UK. So ultimately, what does an interest rate cut mean for those of us who are property investors? Well, if you're on a tracker rate, especially one that tracks a Bank of England base rate, you're probably in a very good position right now because the Bank of England base rate has dropped so significantly. Now, ultimately, that might give you a period of time where you have a significant reduction in your mortgage payments, which may help to offset some of the potential issues we might have with potentially tenants having difficulty paying over the short term because of situations with their employment, which will affect their ability to pay. But the majority of us probably aren't on tracker rates because most of us who are professional investors will gravitate towards fixed rates overall, or if we are on tracker rates, a lot of these tend to track LIBOR rather than the base rate directly. So at this stage, it's really the liquidity that is probably more likely to have an impact on the actual pay rate that we pay. And as long as there's liquidity still moving through the system, we should see interest rates remain at a fairly similar level or potentially drop a little bit. We know in the last few months we've seen a fairly large influx of liquidity into the property market overall in the UK, and lenders increasing competition with each other, fixed rates dropping, especially over the 3 to 5 year period, from a number of lenders that we might access in the marketplace. And the Bank of England dropping the base rate will probably increase the ability of some lenders to drop some of their rates as well, with some of their fixed rate products as well. But don't expect that suddenly we're going to see all of the mortgage rates drop by a huge amount. We've got to remember this at the moment is a big drop in the Bank of England base rate, not just directly affecting the property market, but to make lending and borrowing and liquidity a lot easier for business generally in the UK. So a lot of the money and a lot of the pressure from government is not necessarily to drop the rates on mortgages for property investors like us, but it's to allow lenders to offer things like business interruption loans at a relatively attractive interest rate to help businesses trade through this very difficult period of time. I'd also suggest at this stage that a big drastic cut in interest rates like this means that at some point these will have to go up as the UK comes out of this crisis as well. So most investors maybe take advantage of this right now, especially on the purchase of any property. Generally, we would take a variable rate, something that's not locked in. But for the longer term, still look at your fixed rates for the longer term, because that way you know where you are. You've got a good idea of your profitability by having that fixed rate. You've taken out one of the biggest areas of uncertainty. Now, when interest rates might change again, when they might go up, whether the government will put pressure on the Bank of England for even more quantitative easing, what other measures they might do, we don't know at this stage. This is a situation right now. Interest rates can't really drop much further than this unless we go to the other way and we've got effectively a negative interest rate. So at this stage, it's really about keeping liquidity in the marketplace. Keep an eye on what's going on with fixed rates. And as I say, don't try and time the market or do anything particularly clever. If there's a short-term opportunity to take some advantage from this in your portfolio, by all means do that. But for the long term, it's still worth having the majority of your portfolio sitting on fixed rates so you know where you are. You can budget effectively overall.